With falling gold and silver prices again, primary gold and primary silver miners are back in the danger zone again. I'm recording this video on Sunday, July 15th, 2018. As of this recording, spot gold and silver prices, in US dollars, we have gold around $12.41 an ounce, silver at $15.79 an ounce. So I want to show this with a case study to show that the primary gold miners, their margins are not as good as they claim. And it's not just Barrick Gold, but we'll use Barrick Gold as a case study because Barrick Gold is one of the largest and lowest cost primary gold miners on the planet. According to their website, Barrick Gold has 2018 production guidance of gold production of 4.5 million to 5 million ounces at a cost of sales of $810 to $850 per ounce. Cash costs, as you can see there on the screen, and all-in sustaining costs, which are the most important thing, of $765 to $815 per ounce. Gold production in the first quarter was 1.05 million ounces. Second quarter gold production, they just put out a PR this past week of 1.07 million ounces. And their Q1 2018 financial results disclosed free cash flow of $181 million for the quarter. Barrick Gold is a profitable, low-cost gold miner with an improving balance sheet, and they actually recently got a credit rating upgrade from S&P Global Ratings and Moody's Investor Service. So their balance sheet is improving. Their new CEO is doing a very good job compared to past CEOs at Barrick Gold. So there is progress there. Costs have been cut. Bad assets have been sold off for cash to fix the balance sheet, etc., etc. However, in Q1 2018, the gold price was higher than it was in this past quarter that ended at the end of June, Q2 2018. And now, as we all know, the gold and silver prices have been having another correction due to a number of different reasons, one of which is the dollar rally. There's also other reasons as well. Demand is very weak in the West for gold. So in theory, if Barrick Gold's all-in sustaining cost numbers are accurate, then Barrick Gold should have had at least $500 an ounce free cash flow margins for every ounce of gold Barrick produced in the first quarter of 2018. And that's given their all-in sustaining cost guidance on the last slide, between, I believe, $765 an ounce and $815 an ounce. We'll assume the highest end of their guidance. However, if you do the math using their stated gold production, their realized gold price, and their stated all-in sustaining cost versus the actual Q1 2018 numbers they reported, their free cash flow numbers, things don't match. And there's an enormous discrepancy. I'll show you guys the math now on this slide. Okay, so we're going to do some basic math. I highlighted this out. I actually recorded another short video yesterday, and just me talking without the slides, it wasn't going to really show you guys the discrepancy that much. So I think it's easier for me to do the slides. I spent 45 minutes on the slides, guys, so hopefully you're appreciative with this case study. And like I said, it's not just Barrick Gold where there's problems. This is an industry-wide problem here where the all-in sustaining cost number is not accurate. Okay, so just some basic math. 4.5 million ounces of gold production times free cash flow margins. We're going to assume a $500 an ounce, and we have to assume $1,300 spot price for their Q1 2018 numbers, and then Barrick's guidance of $815 an ounce, and that equals around $2.25 billion in annualized free cash flow. That's what Barrick should have, okay? If everything is kosher the way that they're saying things are, that their costs are accurate, their all-in sustaining costs are accurate, and their free cash flow margins are accurate, that's how much free cash flow annualized they should have given the low end of their gold production guidance. The numbers are even worse if you assume the high end of their gold production guidance annualized of 5 million. Okay, same calculation with $400 an ounce in free cash flow margin. You're replacing that instead of 500, and they should have 1.8 billion in annualized free cash flow. Okay, still, this would be a robustly profitable gold miner if they had $400 an ounce free cash flow margins or $500 an ounce free cash flow margins as they claim. So in order to look at these numbers compared to their Q1 2018 free cash flow number that they reported of $181 million, we have to divide the 2.25 billion number and the 1.8 billion number by 4. So we get a quarterly number to compare. And when you look at that, you see that Barrick Gold should have free cash flow margins for first quarter 2018. They have not announced second quarter of 2018 yet. I'm sure they'll be profitable. It probably won't be as profitable, though, as first quarter because oil prices have risen and gold prices in US dollars have fallen. And so they should have free cash flow margins, according to their all-in sustaining costs, if you believe them, of $450 million to $562.5 million in the first quarter 2018, if their all-in sustaining cost numbers were accurate. Now, let's look at reality. So Barrick Gold announced first quarter 2018 free cash flow of $181 million. If you annualize that number, that's only $724 million. Still a lot of money, but nowhere near the numbers that Barrick is saying that they have. So this suggests that Barrick Gold's free cash flow margins are far lower, and their real all-in sustaining costs are far higher than they claim. Real margins far worse than claimed all-in sustaining costs if you assume higher end of production guidance. So if Barrick is producing, instead of the 4.5 million ounces per year of gold, if they're producing the 5 million ounces a year of gold instead, their free cash flow is actually worse because they have more revenue and they're getting less margin. Do you understand that, guys? Which means that the only way to explain that, if you have more revenue but less margin, you're inefficient producer, you have less free cash flow, your capex is high, and probably because Barrick does mine a lot of copper, they're either producing that copper at a break-even, so it's barely treading water, it's not covering their maintenance capex, most likely if it's only breaking even, and they may even be producing that copper at a loss, ultimately. So the conclusion, when you look at the all-in sustaining cost numbers versus the reality, and I've done past videos on this earlier in 2018 with the primary silver miners where I said they were under, companies like Hecla and Coeur d'Alene were drastically underestimating their costs, is while all-in sustaining cost metrics are far more accurate than cash costs were a total joke. Gold mining companies still report it. Thank God they have better measurements than with all-in sustaining costs. The cash costs were not accurate at all. They were a total joke. The all-in sustaining cost metric is far more accurate, but nowhere near as accurate as they could be if the miners wanted. So if the industry as a whole wants to be more transparent, in my opinion, what they should do is start to present an easy to understand itemized costs and not stick it in the footnotes of a quarterly report or an annual report in tiny little letters and all these, conversions and things like that. Put itemized costs so the average person who does not have a financial background can understand the more regular costs of the business to show a more accurate cost number. But maybe mining companies don't want full transparency, as it would become evident that most mining companies routinely struggle to maintain strong and consistent margins in bull or bear markets and generate consistent free cash flow. And we've seen this in the past with miners, that when the gold price and silver price were going up a lot, their costs rose, so they could not protect their margins. Even though the mining shares went up, the operational businesses themselves were not robustly, the free cash flow did not explode. And in bear markets, the 7-year bear market that we've had basically for gold and silver since 2011, the miners have been behind the curve on cutting costs, at least most of them have. Although they've been doing a better job the last couple years of cutting costs, initially the first few years they were struggling to cut costs at the pace that they should have been. So, in conclusion, Barrick Gold, while profitable, is nowhere near as profitable as they claim. Barrick Gold claims to have free cash flow margins of at least $500 an ounce in the first quarter of 2018, when in reality they had free cash flow margins closer to $200 an ounce. And you can kind of reverse engineer that by multiplying, 200 times the 4.5 million ounce production guidance and seeing that annualized free cash flow number. So it's closer to $200 an ounce. And in my opinion, their real all-in sustaining cost number is closer to $1,100 an ounce and not the numbers that they claim. So their real all-in sustaining costs for Barrick Gold, based on the free cash flow they reported in Q1 2018, maybe these numbers will change for different quarters, but based on those financials that I saw, they're nowhere near their all-in sustaining cost guidance of $765 an ounce to $815 an ounce. Huge discrepancy. So if their all-in sustaining cost numbers were more accurate, they would have had a lot more free cash flow. They only had $181 million in free cash flow in the first quarter of 2018 versus my projections of minimum $450 million for the quarter using their all-in sustaining cost claims. So this is an enormous discrepancy in projected margins versus reality, and I don't want to single Barrick Gold out, even though we're using them as a case study, because in my opinion, and if you talk to a lot of mining executives, I've interviewed Jeff Sonoga about this. He used to work at Barrick Gold. I've spoken with Nolan Watson about this. This is an industry-wide problem. I think the industry is still apprehensive about reporting every single cost because it'll show that the mining companies really, really struggle to protect their margins. And earlier this year in 2018, I did a few short videos outlining how some of the largest primary silver miners were getting out of the silver business as much as possible and moving 50% of their annual revenues into gold mining by producing gold mines. So silver miners' margins are worse than gold miners' margins. So gold miners actually have decent margins still, despite the gold price in US dollars having a correction and going down. Silver miners are even worse. So without silver byproduct from copper and base metal miners, annual silver supply would be in tremendous jeopardy over the next couple years because the silver miners just, frankly, they don't have the margins. They don't have the capital to reinvest in exploration. They don't have the capital necessarily to bring on new silver mines. And as I've outlined countless times in videos, there's very few new silver mines that are coming online in the next couple years that are economic at current silver prices. There's basically 2 or 3. So you have Mag Silver, I've talked about that at length. You have Cerro Moro from Yamana Gold, and then you have Alexco, which has gotten their costs down a lot, and they're restarting in Canada. And Yamana Gold is bringing on the Cerro Moro mine in Argentina. That's a gold and silver mine. And the other thing that I wanted to bring up too, and this unfortunately, I think this is going to exacerbate things for primary gold and primary silver miners, is that falling metals prices plus the higher oil prices, because oil has rallied a lot since the summer of 2017, and it doesn't look like oil's necessarily going to crash anytime soon. Maybe in 6 months or a year, it could potentially if a lot more supply comes online, but it's not imminent crash in oil prices. And that now means that margins for both gold and silver miners will be even further squeezed going forward, unless we have a rebound in metals prices and oil prices fall. So the mining industry for primary gold and silver miners have been in massive cost-cutting mode for 7 years now, with exploration budget slashed to near zero, cost cut to the bone without shutting down mines, and now there's very little capital available for miners. Nolan Watson has outlined this. I've talked about this, how juniors, a lot of solid juniors can't raise capital, and Sandstorm Gold and Osisko Gold Royalty were able to go and buy royalties for cheap just for funding some private placements. And a lot of investment banks and merchant banks have shut down their financing arm for raising capital or raising debt and bought deals and things like that for producing miners or near-term producers, etc. So if producing miners need to raise a lot of capital, they have limited options now compared to the past. And basically, in my opinion, I've talked about this countless times as well, the big 5 precious metals royalty and streaming companies are going to benefit from all the things I've discussed in this short video so far. Last part, continued conclusion. So from Barrick's website, they seem to be barely breaking even on their copper production, which really means that their copper mining is not even covering the maintenance capex required to maintain the revenues there. So I don't know if they want to sell it at a loss. I think they've sold some of their copper projects at a loss. There has been enormous write-downs, but if you, in the mining business, if you have revenue only generation mine and you can't generate any free cash flow from it, you have huge maintenance capex bills, capital expenditure or capex bills coming. And so it's not really going to be worth the revenues because your maintenance bills down the line are going to be enormous. So Barrick's copper is not providing them, it seems, any free cash flow. And, normally with a lot of the mining companies, they, in order to show sometimes a lower cost for gold and silver production, they include byproduct tax credits. And the problem with the byproduct tax credits is when you look at the financials, they don't really give the miners real free cash flow. They just allow the miners to show an accounting lower cost and an accounting profit. The operational part of the business is not generating free cash flow. So they just normally allow miners to report lower costs than reality. And I've kind of highlighted this not only in this video, but also many of my past videos. So the other thing about Barrick Gold is that they were, at least at some point, giving, it was silver Wheaton when they did the deal, but now it's Wheaton Precious Metals, a lot of silver byproduct from their other mines because of the Albatross fiasco of the Pascua-Lama. So Silver Wheaton fronted them hundreds of millions of dollars to start construction on Pascua-Lama, and more than $8 billion later, that mine was totally written off. To the new CEO's credit, because that's a white elephant project, it's going to be too difficult to bring on. He stopped spending money on Pascua-Lama for now. but, Wheaton Precious Metals is still owed. So there's probably some extra financial considerations that are going to be quite large for Barrick to Wheaton Precious Metals. Otherwise, Barrick would probably have some silver, although the silver margins may not necessarily be very strong right now anyways, because like I've highlighted in the short video, silver margins are nowhere near as good as gold margins. And the last thing I want to mention in the short little video is that based on a lot of this, and like I said, I don't want to fully single out Barrick Gold, even though we talked about it the whole video as a case study, that industry-wide, I would expect many primary gold and primary silver miners to have far worse margins in Q3 2018 due to higher oil and diesel prices, the rally that we've had, and that makes up about 30% of production costs for mining, and falling metals prices compared to the first quarter of this year and the second quarter of this year. And it's a legitimate question, and I'm not sure a lot of the mining company CEOs who are producing miners will honestly answer this, is how much more margin compression can the miners take? So something's going to have to give. It's not sustainable, though, to maintain high supply levels that we've had, especially for silver, when you don't have the free cash flow to reinvest into exploration budgets, into maintenance capital at producing mines, etc. So I don't know, something's going to have to give. Either demand's going to fall a lot. We don't really see demand collapsing for silver or gold from India and China and Russian central bank and ETFs in China. We don't see demand falling there. Demand in the Western world for physical metal has fallen a lot. I think a lot of smaller mom and pop bullion dealers over the next couple years in the United States, especially if they bought their inventory on debt, they could be in trouble. So we're going to have to see something give. Margin compression, the miner, look, you cannot have a bear market for longer than 7 years and maintain supply levels and continued margin compression. In my opinion, the way that they have gotten away with this, with the paper price manipulation, is the physical metal is still needed. And for silver, how the market is still maintained supply is, as I've spoken with the manipulation of keeping a higher copper price, not allowing copper price to crash, and that keeps an enormous amount of silver byproduct online. And so like about 70% of the annual silver supply around there is from copper and base metal byproduct. And if you're a manipulator, you can manipulate the paper prices of silver as long as you have enough byproduct of silver from base metals. And then you do that by keeping base metal prices higher. Okay, guys, well, that's it for this short video. Comment on your feedback below. But Barrick is a low-cost producer in the industry, but it looks like Barrick's real costs are closer to $1,100 an ounce and not the production guidance they have. And if Barrick, their costs are there and they're one of the lowest cost guys, that's a scary thought for a lot of these other higher cost gold miners when the gold price is getting eerily close to $1,200 an ounce. Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street for Main Street YouTube channel if you have not already done so. Thanks for helping Wall Street for Main Street pass the 20,000 YouTube channel subscriber milestone despite YouTube censorship. Hopefully, we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down this channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street for Main Street email list that's on the wallstreetformainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetformainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing my loyal listeners with some of the best information, analysis, and financial education available out there, free or paid, as I work to grow the podcast and also get my educational technology company funded.